Welcome to First Responder Financial Freedom Podcast. We talk to first responders all over the nation who are investing and working on businesses outside their first responder jobs. Our goal is to motivate and educate each other and help provide a better financial understanding for a better future. Now here are your hosts, Mike Webb, Tyler Thrush, and Aaron Foster.
All right, everybody, welcome back to the First Responder Financial Freedom Podcast. Just Mike and Tyler today. We're just going to kind of shoot the breeze, go over some stuff, what's in our businesses, what we've been talking about recently offline, and hopefully you guys find some value out of it. So with that, I will let Mike start and just kind of give you guys an update as far as what's going on in his business, and then we'll go over my business as well.
Yeah, so little take two on the intro, no big deal. You should know this by now if you've listened to more than one episode, that podcasting is still a work in progress for us. No, man, what's going on? So if you follow me on social media, it's at The Investing Fireman on Facebook or Instagram. I've been sharing a little bit, and somebody commented the other day, and I didn't intentionally mean it to come across this way, but I was kind of glad it did. He said, "I'm glad you post whenever you don't win on here, because I think it's very easy and everybody wants to advertise what's going well. And we can certainly talk about some of those things. But frankly, I've been taking a lot of punches to the gut with the rental portfolio lately. And, it's like I have two $10,000+ turnovers within 30 days. That sucks. That wasn't even the one I posted. The other one I posted was 5,000. So there's 25 grand in real dollars that's not going into my pocket. So you take a spreadsheet, you take a pro forma, and I say all this just because I think it's important that you realize not everything's puppy dogs and rainbows when you get into investing. And that's with any business, any sport. Think about the job. Not every shift is great. Not every call is great. And it's no different with this. So I think it's important just to keep that calibration. At least for me, it is, because I can get pretty bummed whenever it's like you have 3 or 4 of these things happen in quick or close succession. And it's like, man, you start doubting, like, am I doing the right thing here? And I think it is important to constantly reevaluate. But yeah, truth be told, the rental portfolio has taken some heavies lately. And, it sucks whenever you turn something over and it's like people just beat the crap out of it or whatever the case may be. And just goes back to executing the basics beautifully. And that's something I always talk about with rookies is just be really good at stretching lines, banging ladders, protocols, policy, area knowledge. It's the same thing. Like, don't get so worried about doing some of the fancy stuff that you forget to do those. And I say that with rental properties, don't forget to manage your property manager well, making sure they're doing the inspections the way you want them done, and just staying on top of those types of things. Not that our property manager necessarily caused this scenario. One of them was a big plumbing issue, not their fault. One of them was one of the tenants ended up hospitalized, and the other tenant, the guy on the lease, just rolled out, never paid a bill, left a bunch of stuff, took what he wanted. And then the third one was placed by a previous property manager, and basically they violated the lease. They had a dog. Turns out, they didn't report a bunch of maintenance issues that, had they been reported early on, could have probably saved us thousands of dollars. But that's kind of what's going on with some of my business right now. How about you? You still hold a handful of rentals, right? Up in Idaho?
Yeah, I do. And it's funny, like, same thing with me. We just had 2 at the same time. One vacated, one we evicted. And then it's like, you take those cash hits up front. And it's like, it brought up something up that I saw the other day. Aaron Mazzarello, he's been on Bigger Pockets. He's been around for a long time. He's a local investor where I live in Southern California, obviously not in Idaho. But he's always saying that, your flipping and wholesaling business is good for those big chunks of cash. And what I was thinking when you were saying that, Mike, is when you and I were both more heavily involved on that side, 25 grand still hurts, but you know you have a couple of deals on the flip side that's going to just absorb that cost right away and take care of it. So those are always things that I'm thinking about, and I'm trying to think, okay, well, now that I have these two hits, what do I want to do? Do I want to refi them? Do I want to put them up on the market to sell? Or do I want to re-rent them? And then I was talking with my guy in Idaho. It's like, if you sell them, then you got to recapture all those losses that or all the gains that you've depreciated. If you refi, you have, higher interest rates currently. Or if you use cash, then now you're taking cash out of your available cash for other assets or other investments, and you're redeploying it into your rentals. So it feels like when it rains, it pours. But at the same time, I think we have to look. Like, I know I bought the two that I'm talking about specifically in 2020, and they've almost doubled in value from what I purchased. So I can't complain. It would just be nice if equity was easy to be accessed instantly without a bunch of costs. So similar boat. I think we both like the hard money in the lending aspect because you don't have to deal with a lot of that. Now, granted, those are going to have problems of their own. But it's just interesting. Yeah, so I'm on a similar business path as far as the rentals go. Mortgages have been slow the last couple of years after being insanely hot for the first last couple of years. And the cool part about this time is 2007 through 10, I was not expecting any of this, and I got a major gut punch. So this time, I knew it wasn't because I was awesome at my job. It was I am better at my job, and the market was awesome. And that's what was dictating the deal flow. So this time I understand that. And like you mentioned on the side, so that the Fed met this week, and the Fed just met last week, and then we had CPI come out, which is a measure of inflation. And they were expecting a 0.2.
That's consumer price index, correct?
Correct. So that's gonna measure all the prices on your goods, things like that, housing, insurance, stuff like that. And it came out just 1/10 of a point higher than what it was expected, and it was disastrous for bonds. It was terrible. And then you had a bond auction, a 10-year bond auction later that day, also sucked. So it was the double whammy because there was no appetite for the bonds at the set price that they were expecting. So then rates indirectly go up because of that, right? And then the funny part was PPI, which came out the next day, was a little bit better. So that tempered what happened earlier in the week. And then while you were talking, I knew we were going to talk about this. Let me see if I can share this. This will be kind of funny to watch. You'll see what I look at a daily basis for mortgages and kind of how it's up and down. So let's see here. Hold on. I don't want to show you my policies. I don't need to look at that. Where is this going? No, not that. Can you see this, Mike? Can you see MBS Live? Or no?
Not right now, no.
Hold on, let me pull it back up then. Okay, so there we go. That should be it. Let me see if this works. No, it does not.
For those of you just listening, we're technologying.
Yeah, we're not coming in hot. So let me see this. But anyways, while I'm pulling this up, I'll keep it going. Basically what happened today was there was news that came out in Europe, and it was favorable for bonds again. That's not working very well. Sorry, guys. We are technology, and it's not going well. There we go. There's MBS Live, right? Okay, so this is what I watch daily, and this basically shows up to the minute information for bonds, interest rates, things like that. And it's not going to let me log in, so let's pop it off. But basically something happened in Europe today, and then rates are getting better. The entire screen is green, right? Every single 10-year, 2-year auction, everything is showing up good, and it's going to come back down. So this last week was kind of indicative of the last 2 years where there was upward pressure on rates, coming back down. Upward pressure on rates, coming back down. And I think, honestly, I don't think the Fed is going to increase rates at all. They were going to have, it was expected that there would be 6 rate cuts now. I think there's going to be maybe 1 or 2. I think the earliest, based off of what I've been hearing and listening to, is September. So we're going to have to temper expectations on the interest rate side. which is going to do a couple things. I think it's going to allow people who are aggressive enough to buy stuff at the current moment at good prices. And when that happens, I think it's going to be a feeding frenzy on that side. I don't know about you, Mike, but I know like in SoCal, all the retail agents that I'm talking to, multiple offers. Like I talked to an agent that lives where I live in my home market, and I want to say they have 60 to 100 showings on one property because there's so little inventory. And I think a lot of people are saying, well, you guys are just trying to pump this stuff up. You guys being realtors and mortgage brokers, lenders, stuff like that, because you want the market to go. We're not saying anything. We're saying inventory is so tight still that when something comes up that's priced appropriately, there's a ton of traction. So when you drop interest rates and make even more people pour into the market, I think that's going to pour gasoline on the fire.
Yeah, totally. And we just had our in-person local meetup last night, and we always go over the local statistics. So just, this is not for the entire US, but in our local area, there was still less than 3 months worth of supply available in inventory on the market. So anything below 6 is considered a seller's market. Anything above 6 months worth of supply is typically considered a buyer's market. So right now, if no new listings got listed in my area today, within like 2.3 months, we would be out of inventory. And of the houses that get listed in our area, 53% go under contract within 10 days. So we can sit there and trust me, I'm in the boat where I would benefit from a rate reduction just because I could refi out of some stuff that I still have with private money. However, it allows you to go in there and use these current rates and say like, hey, I can only afford to pay this. And if you can make it work at these numbers and this rate, then if or when the rates soften a little, you can always do a rate mod or a loan modification or a refinance or whatever. And at that point, theoretically, it should become even better of a deal at that point. But as soon as the rates go down, the competition goes up. And right now, the competition's already fairly high, even without the rates going down. So it's kind of like this weird time where in my adult life, I haven't really seen this. I'm sure many people have, but for me, I haven't seen much of it, and I've never lived through a very inflationary time. So this has kind of been like new to me, but it's not new to America per se. And if we drop the rates down to 5%, well, guess what you're going to have again? You're just going to have people offering $350 for a $250 house. Yeah. Bill just had one. He was writing an offer for the buyer. They had 10 offers. It was an $800,000 house. They offered like $850, like no inspections, all this jazz. It ended up going under contract for north of $1 million, no inspections, cash. Now I know where you're at, Tyler. That's not like abnormal, probably.
No, but that's
where we're at, and the average price point's probably about $450. To have $1 million cash sale, so $200,000 over asking, no inspections, cash sale. I mean, so I'm not saying that happens all the time, but like that stuff's still out there. People are still writing escalation clauses. I actually asked the room, I said, because there was a lot of realtors, because we talked about the NAR ruling last night, so it got a little fiery. But I said, how many, I always like to poll who's sold a house or who's bought a house since the last meeting, just to kind of keep my pulse on the market. And it's like, they're like, oh, I sold a house. I wrote 3 offers, this, that. And I'm like, how many of them had escalation? She's like, all of them had escalation clauses. The one I just wrote had appraisal gap coverage. And I'm like, damn. And that's what 7% rates. So you can only imagine if it dropped down to like 5 or 4, because I forget the number, you might know, but it's like for every 1/4% or 1/4 point or whatever it is, it brings like 50,000 new buyers to the market or whatever.
So for every
it's something along those lines. I know that.
Yeah, for every 1% that you drop in rate, 3 to 5 million buyers come back into the market, which is a huge number. And like to your point, so I like that because we'll call that a luxury purchase, right? In your market, that $1 million house be considered a luxury.
Yeah, it was a primary residence, but yes, it was not your average.
It's a nice house.
Very.
which is usually going to be obviously a much slower market, much more discriminating buyers, things like that, because they've been through the game, they've worked their way up in the market, and they're still doing that. And I think here the same thing. And like I purchased a flip in January in Boise, right? And we paid 186 for it, and we didn't know what we were going to do with it exactly because it didn't need a ton. So I'm like, well, January and February are normally super slow in Idaho anyways. I'm like, there's not really a ton of carrying costs for me on this one. I personally chose, I'm going to wait and see what happens. So then we have a property that was just listed a week ago, similar square footage down the street, has no carpet because it got ripped out, which is mine because I always clean the property out immediately to kind of see what we're working with. And if there's, urine on the carpet, it's out. And then because we know we're going to replace the floor no matter what. That property just sold for $300,000. So I'm like, interesting. I don't have to touch this property now. And my original ARV was 340, and I can just list it at 300
without flipping it, right? Oh, dang, you froze. All right, well, I'm going to do the little song and dance until Tyler comes back online here.
There we go. Can you hear me?
Yeah, now I got you twice.
So I'll bump this one out. So anyways,
whatever you switch to, by the way, your audio and video is a lot better. So I don't know
hilarious.
if you just did something, but like you're not fuzzy, and I don't hear that sound I was talking about in my headphones now.
Problem solved. Better to be lucky than good. So yeah, anyways,
Yep.
it speaks to the same point. Like the market's definitely, it's hot still. There's definitely a demand. And like, I'm thinking, okay, this is like one of those markets where we can snag a couple of deals while everybody's talking about how they're going to wait for the market to crash or stuff like that. It's a good time to buy. And one more thing too, before I forget, to your point, I'm doing this. I have some properties that I want to refi, right? And in the state that I have these properties, which is Idaho, I'm not licensed, so I can't do them. And then, so I was talking to the broker and he said, well, what do you want to do? Like what you're doing. I'm thinking, well, you want to buy down points. And in my mind, I'm like, well, no, I don't want to buy down points because I know chances are rates are going to drop sooner than later. And I don't want to have a bunch of sunk cost into buying down the rate when I feel like in a year at the latest, maybe 2, I can go and refi at that rate that I'm trying to buy down, have no sunken costs. And then same thing, my deal is going to be better because I'm going to underwrite at the current debt service coverage ratio at the rates at like 7.99 or whatever it was, right? So I think there's a lot of stuff that can be happening right now that's beneficial for investors and primary homeowners. If it makes sense at the current rates, it's definitely going to make sense in the future, in my opinion. And I'll get egg on my face if I'm wrong, but do you agree with that?
Yeah, no. And I always think back to, I believe it's a Robert Kiyosaki quote. He talks about like, being on heads or tails of a coin, and you never want to be on one or the other. You want to be standing on the spine of it, looking at both sides. And I believe that quote is actually in context for political parties. However, I think about it in the context of the current market. Like, they always say there's a good time to buy, a good time to sell, just depending where we're at in the cycle. And I kind of always think about like that time weighted cost averaging or to like buying stuff. And it's, you probably don't want to go buy a ton, but you probably don't want to go sell it all either right now.
Exactly.
So it's like, okay, well, what do you do? Like, so I've started to kind of switch some of my business model, and to circle back to when I was talking about the rentals at the beginning. It's like, okay, rates are high. Inventory is still fairly low. Where can an investor kind of insert themselves into this type of market and provide some value? So one of the things we've been doing, and it's not always easy, but it seems to be working nicely, is, so I'll use 2 examples. I bought a house from a local wholesaler, paid him his fee. I'm all in it for $90,000 and change, like $90,300. It's a smaller home. It's livable. It's nothing fancy. I paid cash. I didn't borrow any money for it. So then I re-advertised it for sale as an owner finance sale, and advertised it for $139,900. So right there's about a $50,000 equity position. So I'm selling it. And if you've listened to the Travis Oglesby episode, probably the first one, where he talks about equity buyers. So Bill and I went through that training program and basically took that business model. And what we'll do is we'll put this property into a trust. This guy's we're closing next week. He's already put earnest money down and whatnot. He's putting $20,000 down. He's going to pay us, it's on a 30-year term. We're charging him 8.25%, which is actually pretty reasonable.
Pretty good. Yeah, for sure.
Yeah. We were advertising like 8.9, 8.5, depending on the application. And this guy's like, well, instead of 10, what if I put 20 down? Could I basically, in essence, buy the rate down? I'm like, yeah, dude, because sure. So there's a prepayment penalty if it's paid off within 36 months. And I look at it this way, like we're basically taking what would normally be a rental property. The price he's going to pay per month is less than what he would pay for a 2-bed, 1-bath apartment. This is a single family home with a yard. And like I said, it needs next to nothing. It needs the bathroom cleaned up and remodeled, but not like entirely. So we're going to have a $50,000 equity position. Every month we're collecting the interest, and we're doing that for 3 years, presumably, before he pays us off. We still hold the deed, so we still get the tax benefits. And it's kind of like one of those things that it's his property per se, because it's kind of like a rent-to-own owner finance model. So the repairs are on him, the taxes are on him, the insurance is on him. So we escrow everything into one payment. And it's what I've started to kind of consider like the residential version of the triple net lease. Okay. So like, if you're not familiar with the triple net lease, it's basically what is pretty common in the commercial space, to where the tenant of like, say mattress discounters that was in a strip mall, they pay their rent. Then they often will pay what's called common area maintenance fees. So that takes care of the lawn care, the snow plowing, the stuff on the outside. Every tenant pays a portion depending on the square footage that they rent. They pay the property taxes. They pay their insurance. They pay for any build out or upkeep. So pretty much the owner doesn't have to deal with a lot of the things you deal with in residential real estate. So that's kind of how I've started to look at some of these owner finances, is like, hey, I don't handle the repairs. They put down enough. Like this guy, if he walks away, he's going to lose $20,000, where most rental properties, at least where I live, you're not getting a $20,000 security deposit. Most of them by law, you can only get three times the monthly rent or somewhere along those lines. So he's heavily invested to see this through. And at the end of the day, the property fixed up, shined up a little bit, would probably appraise for about 165, 170. Okay. So if he does all this, he's got a little bit of an equity spot. We're getting paid, and it's kind of like the marrying of all these different things I like while offsetting the current rate environment. So how does that pertain to the rates? Well, right now, he's one of those guys that, like, with rates where they are, he can't afford to go get traditional financing. He deals with mainly a cash business. Like, he doesn't have the best credit. It's not horrible, but like, I just actually saw somebody with like a 380. I didn't even know you could go that low. Yeah. I was like, damn. I was like, you'd have to like try to do that. But anyways, I like it because there's another one. We're actually closing it today. I think our underlying financing is like 5.5%. So what I like about the owner finance is, if say rates are 7 today, well, I just bump it up 2%. So I'm charging 8.9% then to my end buyer. So if I have financing at 5%, I can charge them 7%. So you're basically, whatever the current interest rate is, you're just hedging up a little bit, and it kind of protects you. So at the end of the day, I don't want to say you don't care, but you don't care as much what the current rate is. You just figure out a way to arbitrage it a little bit. But that's kind of what we're doing right now that is working, which is nice.
Nice. And I think that's like a big thing, right? People who adapt in real estate are going to be successful. And then people who, it's kind of like the fire department. This is the way we've always done it, is the most dangerous phrase you can say. Right. And it's like, if as long as you can adjust, I think there's always money to be made. And yeah, you made me think too, like, well, I have one of the properties that I do have underlying debt on, like at 4%.
All right. Tyler just left the show, I think inadvertently. We'll be back in a moment. In a moment.
Good grief.
And we're back.
I know. That I have underlying debt on, like at 4%. And I'm like, well, I don't really personally want to spend a ton of money to fix it up to get it rent ready again, to be honest. Why don't I just offer it sale via owner finance? Somebody who's handy could fix the property up. I'll give them a good deal, a fair. I mean, if I charge them 7.9 and 8%, I'm doubling my interest rate from what I'm currently paying, and I'll get a down payment. And so that's what I love about real estate. I think I've talked about this before. I think there's so many ways to be creative in real estate, and I think a lot of people don't think that there's a lot of creativity in investing, but I think that's like the biggest asset. There's a guy that went to our my mortgage mastermind, and his name is Chris Doe. And he's like he's very creative. Have you ever heard of him?
No, I was just giggling at the name.
Oh yeah, he's smart, right? So his book is pocket full of dough. All of his stuff plays off his name. The guy's brilliant, and he was funny because he came to our mortgage mastermind and said, "I didn't realize that people in this industry were so creative." And I think a lot of us are taking like a brick and mortar business, dealing with properties, real estate financing, which is not very entertaining or sexy. And there's a lot of creativity. And I find like the people that are the most successful are able to turn and not focus on the past and always be forward facing and adjusting. So like that stuff a couple years ago, Mike, at Fuel was never really discussed. I remember the first person who I really heard discussed it, and I shouldn't say never, it was just not in vogue. Everybody was flipping wholesale. And then I'll never forget, I saw Brandon Smith very early on start to tweak his business model to basically becoming a bank with all the houses they buy and doing this on a large scale. And my eyeballs were like this big. I was like, holy cow, that's such a rad model, because there's so many different ways to make money. You're insulated from the fluctuations of, interest rates. It's you're setting the rate, you are the bank, and you have the product. So you have like a 360 of everything. You're getting paid all these different ways.
Yeah. And people often ask, when I talked to Brandon, so he was the one that helped me build our banking Bible. Basically it's a credibility pack, and showed me how to look at different banks, seeing what they have in deposits versus loans and who might be hungry, who's not. And at that time, I think he had like $8 million in notes. And I was like, dang, that's where to be. But there's no TV shows about that. Nobody cares about notes and paper, but the more you do it, you're like, yeah, that's where it's at,
100%. Like, that's the top of the food chain.
Yeah. So, damn, what was I going to say about that?
While you're thinking, let me, once you think of that, let's talk about, I'm interested to see how the whole NAR settlement went over at your meetup, but.
Dang. I felt like I had to apologize to our speaker. He was a broker and he managed like multiple Coldwell Banker offices. And it got, I don't want to say heated, but like it was the most, we'll call it interactive meeting we've ever had. And actually, shout out Mark Baxter. He attended.
Oh, cool.
Member of the first responder group, showed up in person for real. So that was, I told him, I said, hey man, it's not always this crazy. Sorry about this. But it was good. Just, I don't even want to get into it because it's frankly, to me, it's like a moot point. My personal thoughts, while they don't really matter, like I think the whole NAR thing is like that business model is antiquated and they're grasping at straws as it is. And I think if you're a good agent, there's really nothing to worry about. If you're one of these bottom feeders, they're probably going to not do so well with the way this is going to go. And basically the very Cliff Notes version, I'm not an expert, I'm not a realtor, not a broker, is right now, if I go sell a house, I compensate the buyer's agent and the seller agent, my agent. And, I get it. Like technically it goes to the broker, then the broker pay all that BS. Okay. I get it. But at the end of the day, it's coming out of the seller's proceeds. And they argue, well, the buyer's bringing the money anyway, so ultimately they're paying for it. Just like we can sit here and mince words all you want. The way they have it, the judgment now, I think it goes in effect in July, is the buyer would be responsible for paying their representation. And the thing is, nobody, like the realtors don't like, is, hey, most of these buyers don't have enough money to furnish their house, let alone get the down payment plus pay a commission. So they're just worried how they're going to get paid. So
yeah. And I think too, like, it's funny, like people are so freaked out. Like the seller can still pay the buyer's commission. They're just not allowed to advertise it on any MLS. And then number two, kind of what we were talking about earlier, is there's mortgage brokers that I know that we're trying to like figure out ways to get around this. And that's what, like, the whole creativity of the market. And to your point, bottom feeders, people who are not confident in themselves or able to figure out ways around things, you're going to die in any business. People who figure out a way to make things happen right now and get a good solution, they're going to thrive. Your business partner, Bill, top tier agent. I highly doubt this. Once he figured out what the ruling was, I don't think he was quaking in his boots. He knows his value. He knows what he brings to the market. If anything, it's going to eliminate competition for him without him having to do anything, coupled with a market that's tough too. It's just going to grow his market share. And I just think there's a lot of people who are worried, and I think it's the people at the bottom. And I also don't think, taking my agent hat off, broker hat off, and being a consumer, I honestly don't think most of the time it is ever a good idea for a buyer to represent themselves on the purchase of a home. If they're in the industry, maybe, but there's so many things that get missed and messed up. I personally, like, if I was going out of state and I was not licensed in a market, I would definitely go do it. Because I don't want to deal with all the paperwork and all that stuff and the inspections and everything. It's just the cost of doing business. It's hire a professional agent that knows what they're doing. And that's all I have to say about that. Because I think people think, oh, I'm just going to represent myself. Okay, well, let me know how that goes. I don't think it's going to go. There's some people that can. I just don't think the majority of people are qualified to do it. And that's not a knock. No. There's a reason you have professionals in every marketplace.
Yeah. So I don't know. It was heated. It was a good discussion. But frankly, I would say for most of our audience, it doesn't pertain to them. And at the end of the day, I think the market will take care of itself. They'll figure it out. They're going to get paid one way or the other.
100%.
So what do you got kind of coming up? Anything good? You said you got a flip. Are you working on that, or?
Yeah, we're gonna wholesale it. So we're gonna wholesale that flip. Our SEO.
And
go ahead.
What is wholesaling? Just in case nobody's heard that term. I know we've covered it, but just in case it's not a devout listener.
Wholesaling is basically taking a market that we purchase as a flip, getting it to the point where it's able to be sold on the retail market and qualify for conventional financing, and then sell it. We're not going to make as much as if we were to totally rehab the product, but we're also not deploying a lot of capital to get that high end. And for me right now, it makes more sense if I'm going to make a similar spread on a wholesale versus a true flip, to do the wholesale model, make a little bit less, but not have a bunch of capital out that I don't need to have out. And then we're going to take that and we're going to start to redeploy it in Boise. I think Boise's on the way back up, and I think we're going to be super strategic, aim for like 6 to 10 flips this year, and just stay there until we kind of figure out where we want. I love lending. I think lending is the top of the food chain. So that's going to be a focus this year. And I do want to do a meetup with us, either out here in the middle of the country somewhere. I think it'll provide value. I think it'll be fun to meet all of the people that we've been talking with over the last 3 or 4 years, just meet in person, even if it's not going to be some huge event, just an event where everybody gets together. I mean, firemen don't have a hard time having a good time. I know that. And all first responders, I should say. So something like that maybe in the future. But other than that, man, I think I'm at the point where I'm trying to be a lot less like volume focused and much more strategic, and just kind of go that route. I think Tommy posted that too. And I think once you get over the whole need to scale thing, I think you kind of find your sweet spot. And I think that's where you thrive. So that's it for me. What do you guys have got going on? Are you guys still actively pursuing storage? Are you guys more focused on jump camp capital?
I would say those are our two primary focuses. With that being said, like I bought a flip last week. I'm buying one next week.
How are you sourcing those?
One was a referral.
Okay.
And the other one was an agent referral.
Cool.
So it's, I'm not like actively hunting those too much. And frankly, I'm a lot more, I don't want to say picky, but a lot pickier on my flips because I'm not focused on volume. Bill and I said the same thing, like, hey, if we can knock down like 5 to 10 flips this year, to just help offset some of the, like we talked about, $25,000 turnovers or, whatever the case may be. Okay. So that's coming up. The one I posted about the stripper or the strip club, that one, that's one of the ones, like, we were contacted on a Friday. I went and looked at it that day. We purchased it the next Friday as soon as we had title back. So like moved quick on that one. It's not like a home run deal, but it's in a good area. I have to let them stay there for 2 months. So we held back $15,000 in escrow until they move out.
Okay.
But once they move out, I think I can probably knock that one out in like 3 weeks. And we bought it for $150. I can probably sell it for $250. It needs 40 or 50. So it's not like, again, not a home run deal, but it was super simple, pretty cut and dry, easy to comp. It's in the neighborhood.
And then just so real quick, I think you glossed over that, and I love that strategy. And I think a lot of people don't do it. Do you want to talk about what an escrow holdback is and why you did it real quick?
Yeah. So basically these people, I think just years and years of poor decision-making. They didn't have a vehicle. They barely had their water still turned on. Just they needed money. They've refied this house like 3 times. It should have been paid off, but they needed to sell for a multitude of reasons. They didn't have anywhere to go yet. They're waiting for the housing authority to basically approve their application for like the older folk senior high-rise thing. So that takes a little bit of time. Once that gets approved, they'll move out. So just to make sure they move out within the 60 days we gave them, we kept $15,000 of the proceeds in escrow, basically in a holding account with the attorney, so that once they move out, they will then get those proceeds. If they don't move out and we have to go to court and do all that stuff, we keep that $15,000 dangled over their head until they do what they say they were going to do. And then we also sign what's called a post-occupancy agreement. So after settlement, you just sign, in essence, like a 60-day lease that just says like, hey, I'm responsible for the utilities. I'm going to move out. I'm not going to make the property in any worse condition, blah, blah, blah. So, perfect. But at the end of the day, the 15 grand is really the carrot and the stick if need be. And then the other one, it's kind of far from where I live. It's like an hour away, but it's closer to Baltimore. And it's one of those, it was an agent referral, just a little 3-bed, I think it's 2-bath, has an acre and a pond at the end of a cul-de-sac, like good little house. It needs probably 70 grand worth of work, but we're getting it for like 210. It's probably worth like 475. So
nice. Again,
I'll probably be able to turn that one over in 4 weeks. So it's mainly cosmetic, roof, couple windows, that kind of stuff. I try and stick to those houses that are built after like 1960 or 70, like where the layout's not functionally obsolete. I'm dealing with one right now, and I've posted some pictures about it. It's kind of like a jump capital loan, but it's kind of like we're also on title to the house. So it's kind of a little bit different scenario. Basically, we're the money, a contractor's doing the work. And the loan matures in June. So it's been basically a 10-month process to this point. Now, with that being said, every inspection takes longer than you want. Every permit takes longer, but it has brand new plumbing, brand new electric, brand new insulation, brand new roof, everything in this house is brand new. And at the end of the day, it's like, I'll probably make the same or maybe a little less on that house than just going through and doing a quick cosmetic flip on a newer home. And this is an old home. Granted, it's got a ton of charm. It'll probably be, as far as like fit and finish goes, probably the nicest flip I've been involved with as far as like quality. Not to say like our other stuff was bad. I'm just saying like it was like the same vanity, the same toilet. Like there wasn't a whole lot of like, it wasn't a passion project for this contractor. This other one has been a passion project. So we've been providing a little bit of direction and just kind of like expressing like, hey, speed is of the essence with these things.
Yeah.
Because granted, we've been able to ride the market the last couple of years, but like what we really need to do is get in and get out because that limits our exposure and our risk.
Absolutely.
So I got that going on. I'm selling a duplex next week, which I'm probably going to try and 1031 a little bit. So I don't know what I'm going to do there. I might just take the tax hit and loan it out. I'm not sure. And
that's the hard part, right? But good problems to have.
Yeah. And storage is moving in the right direction. So I'm going through the ripping the Band-Aid off phase of implementing mandatory insurance.
Okay.
So that goes into effect May 1st. So dealing with some people that aren't super excited about that, even though they have the option to just like file their own homeowners coverage just to basically have on file. But the one facility is at 95% occupancy. We had our best collections month last month. So things are moving in the right direction there. Frankly, it's been a little slow on the move-ins the last like 2 months, but historically that's normal from what I gather, reading, listening, networking. So as home sales volume-wise drops down, the demand for storage drops. So it's kind of correlated because they say like with storage, with many of like the need to sell my house type people, it's death, displacement. I don't know, there's a couple other divorce, basically the life events. And I'm hoping as the weather turns and people start moving, like traditionally when the real estate market picks up in the spring and summer, the need for move-ins increases. The other facility, we're up to like 76. We've been holding strong for 2 months at that one. That was the one when we bought it. It was in the 40s. So definitely moving in the right direction. It's cash flow positive, even at 76%, which is good.
Nice.
And by a pretty decent margin. So I got a private investor I need to rinse out of that one. And once I do, my monthly portion goes up a good bit. So that'll be nice. But other than that, man, it's lending. Just did a couple loans this last month of the quarter. Like the first 2 months of the quarter, we were crushing our goal. Then the third month of the quarter was a little slow. So by the time you averaged it all out, we hit our goal, but still got some room to go. But yeah,
nice, dude.
Focusing on lending for sure.
It was 3 million you said for the year. That was the goal.
4.5. Yeah.
4.5. Okay.
Yeah. So I'm trying, like within the first 40 days, we wrote like 1.2. So it was like good. But always having conversations with capital investors, just always having conversations with good borrowers, just getting in front of enough good opportunities is kind of the name of that game. If you want to keep it consistent, I have a couple repeat borrowers and they've just been doing a great job. It's funny being on this side of the equation. You can sit there and watch the good operators and the less desirable operators, we'll call it, or maybe we'll call it efficient operators, less efficient operators. And I can sit there and be like, man, they're making that mistake, making a mistake there. And you try and provide a little bit of guidance, but like at the end of the day, it's their project. You're the lender. Like you can protect your interest, but like, I can't make them do this or make them do that. But I'm like just sitting there watching some people and I'm just like, dude, you are screwing yourself. You should do this, this, and this. And that's why I'm a little biased, but I think like as far as hard money lenders go, like we provide a fair amount of value because I can come in and we're primarily lending just in the market we work in. So like, I know like, hey, if you go in and you're using this guy, you better do this, this, and this. Because I've been doing it. I've done that. So like, it just makes me, I think, a better resource, for some of these guys that are especially just getting started. Not that I'm an expert or anything, but if I can save you a little bit of grief, man, there's probably a reason I'm telling you because I've been there.
Well, and that's why I always say too, like, I agree with that. If like when we're lending, I like lending locally because you know the market, you know the contractors, if anything should happen, all of those things too, right? But I've always said like when people are getting started and they're trying to figure out if it's a good deal or not, lenders are usually a very good person to submit something to, and they're going to be unemotional. They're going to give you their yes or no answer. And it's usually based off of experience, like underwriters, or like in your guys' case, or like if I look at a deal, same thing. It's like, I had somebody ask me, hey, will you lend on a log cabin? Absolutely not. Know nothing about log cabins, not even going to consider it, because I wouldn't know the first thing what to do if anything went wrong. But you've been doing this long enough in your market. I think that provides a lot of value to your borrower and to the investor, right? They know that your experience is going to keep their money secure. Granted, things always happen, but I think it's a huge benefit. And that's why I think it's, like I said, I think it's a natural progression. You start off wholesaling or flipping, you move up, you're getting rentals, and then all of a sudden you have capital to deploy, and you know who the best operators are in your market. And as long as you give them a fair rate and a good deal, they're going to be the ones that are borrowing money from you. And it's like, I don't know, all the way around, I think it makes a lot of sense. So that's cool that you guys are doing it.
Yeah. So it's been a learning curve, but like it's definitely moving in the right direction.
Nice.
And looking forward to kind of watching that business evolve for sure. So
someday we'll just be private money lenders, hard money lenders, and then that's the fat cat status.
Yeah. I'm listening to a podcast with Jerry Norton right now, and I'm just like, yeah, that dude's kind of top of the food chain there. You
made me just think, there's a guy, Dan Zatofsky. Have you ever heard of him?
No, I've got three now written down on my legal pad here that you've mentioned. How do you spell that last name?
Zitof. Oh man, here, hold on. I'll pull it up right now while we're talking. But the reason I bring it up, for some reason,
is he Polish? Zatofsky?
Yeah, Zitovs. Zitofsky. And I feel like he used to be a PD officer.
Really?
I'll have to reach out to him and get him on the show if he is.
Yeah.
Yeah, I'm almost positive he used to be a cop. All right, well, we're at 46 minutes. We said we were going to try to keep it at 45. You got anything else?
I'm sure I do, but that'll be all for now. So
okay.
If there's anything you guys want to hear, feel free, post it in the Facebook group. If you would, do us a favor. This other show I listened to, they said this. I'm completely stealing it. We have this new thing here at First Responder Financial Freedom. It's called the Gentleman's Agreement. We don't charge you for this.
I like it.
All we ask is that you share it with one person. That's the Gentleman's Agreement. If you don't do it, we're going to kick you out. But so that wasn't my idea. I totally ripped it off from somebody else. But I was like, that's a great idea.
It is good.
But yeah, that's all I got, man. I'll talk to you next week.
All right. Sounds good, guys. And hey, don't take the irregularity of us putting shows out that we don't want to do that. We need your guys' help to either be on the show or invite people onto the show. If you don't have the link, reach out to either me, Mike, or Aaron, and we'll get you guys a link. Until then, we'll catch you later.